This is the stock market for beginners. I have reviewed over 20 stocks, and out of those 20 stocks, all of them are making a profit. Just look at a snapshot. In this video, I'm going to show you how I select stocks. What makes a stock profitable? How do you find those stocks that make it and avoid those stocks that fail? So, if you are ready to start investing in shares and stocks, and start growing your money immediately, get on board. Let's do this. Let's start from the very beginning. What is a share? A share is a part of a business. It's a piece of a business. Let me explain it this way. Apple share represents a piece of Apple business. So if you have a share in Apple, you have a piece of Apple. Maybe you're not getting that. A business in the stock market breaks down their business into smaller parts, smaller pieces. These smaller pieces are then valued. So for example, let's say we have Microsoft and you're lucky enough to have one. You are now a shareholder of Microsoft. You are now the part owner of that business. Now, let's say that Microsoft stock, one share, the one you have, is worth $100. Remember, they have 100 stock and you have one worth $100. It means that in total, the value of Microsoft on the stock market is 10,000 because they have 100 shares and one of those 100 shares is worth 100 naira. So we simply just say 100 shares times 100 naira, we get the value of 10,000. The value of Microsoft now is 10,000. A while back, it was on the news that Apple became a $1 trillion business. Apple was now a $1 trillion business on the stock market. And that's because the price of each Apple stock multiplied by the number of Apple stocks out there was valued over $1 trillion. You get that, right? Now there are different names people use for these things. We have things like shares outstanding. When you hear shares outstanding, it just means how many stocks the company has. If you hear market capitalization, it simply means, okay, that company, that business, they have 100 shares and it's valued at $100. So their market capitalization is 10,000. The value of the business is the market capitalization. Are we on the same page? You get that part? So now, not all businesses are on the stock market. Let me clarify and explain that part better. We have private businesses and we have public businesses. What makes a business public? A public business is a business on the stock market. So why do we call businesses on the stock market a public business? Why do we hear things like, oh, that business is going public? It simply means that yourself or myself, anyone across the planet can own a part of that company. So it's not owned by private individuals any longer. It's now going to be owned by the public. Any single person can buy it. That's why we have public companies and we also have private companies. Our interest, our focus is on public companies. Now, this is very simple. Let's delve into this a bit. Let's say there's a business in Africa, a business that sells yam. I can't think of any other product than yam. It has to be yam. So just calm down. Let's say there's a business that sells yam. When the founder starts that business, he probably funds it from his pocket. He takes his savings, he starts a business, he creates a product, he sells that product, he makes his revenue. Out of that revenue, he pays all his expenses. He pays for the raw materials, for the seeds, for the fertilizers, for harvesting, for transporting the harvest from the farm to the market, and sometimes for advertisements. Now, when he's done with all that, if there's still money left, that money is now the profit. He has settled all his bills after that sale. So now his yam business is making his profit. And that 2,000 is his profit. You get that? And profit is your money. You can't decide to do anything with that money. I guess we're on the same page, right? Now let's look at another scenario. This scenario, the money he made in the market is still 10,000. But this time, the expense incurred is 11,000. It happens maybe due to improper planning, maybe due to COVID, unforeseen circumstances. In that instance, that business made a loss. Now, I'm putting it out there so you know that for every business you see out there, whether they're private or public, at the end of the year, they could make a profit, they could make a loss. That's a possibility. So now, where are we going to with this? Now, let's say for the first year, he made that profit of 2,000 and he's excited. He wants to grow that business. It's his dream job. So this time, the next year, he's looking to make more profit. So how does he make more profit? He has to produce more yams. That's one option. The other option is to reduce his expense. But reducing his expense will mean that he's only still going to make 10,000 and probably his expense will now drop from 8,000 in that scenario to maybe 5,000. I mean, that will increase his profit by 5,000. But most times, reducing your expense is very difficult. It's almost impossible, especially when there's inflation, in a system where there's inflation. Now, in this scenario, we're talking about a business in Africa. Certainly, inflation is affecting it. So how does it go big? How does it make more money? He has to produce more yams. And how does he do that? He has to get more farmlands. He has to get more farmers. He could get farmlands across Nigeria. He could get farmlands in other countries, Senegal, Ghana, South Africa, Mozambique. And his goal, his plan is that by the end of the year, he will go from 1 farmland the previous year to 10 farmlands the next year. And if 1 farmland was giving him 10,000, 10 farmlands will give him 100,000. Are we still on board? You're getting it, right? Straightforward. So now the goal is to get more farmland so he makes more money. The chances of using that 2,000 he made as profit to afford 9 more farmlands, it's very slim. He's going to need money to grow, to afford these farmlands across Africa. So how does he get this money? He only made a profit of 2,000. One way to do that is to go to his bank. Hello, bank. Look, I have one business. I made 10,000. I want to establish 9 more branches. So I need a loan from you to build these branches across Africa to employ staff. That's what I says. This is my baby. This is my dream. I'm sure it's going to work. And the bank will be like, dude, say no more. We have money to loan you. But here's the deal. You're going to pay us extra 17 to 25%. What? Or what? I'm doing all the work. You're just giving me money, which I'm going to return. The bank will be like, no, dude, we get it. We know you're going to return our money. Definitely. That's guaranteed. But there's a cost to borrowing money, and that cost is between 17% to 25%. So don't worry, the money will be ready immediately. Once that money is ready, you can do anything you want. So now our businessman, our yam seller, can decide to take that deal, and he's going to get the money now. But when he makes his profit, he needs to pay back the bank the money is loaning from them. You remember, it's not his money, he loaned it, they borrowed him for a set period. And it's not just that, he's going to pay them interest back, 17% to 25%, he's going to pay that back additionally. So he has increased his expense. Now, most businesses have no choice. They go through this. These businesses will bite the bullet and just take that loan in the hopes of making massive profits that will cover the expenses, that will cover the loan repayments, and that will cover the interest, which is fine. But there's another option. The other option is to go public. Yes, this is the thing. This is where they value the business. Say, oh, okay, you can get money from the public. How do you get money from the public? We'll value this your business, and you're going to sell this business to the public. You're going to put your business on the stock market. You're going to offer your business to the public to be part owners with you. They're offering the money to expand your business. And the great thing, the good thing about this method of offering it to the general public to buy is that you don't need to repay them anything. They're putting their faith in you. They believe in your yam business. They believe that this business is going to go from today's value. It's going to go to a better value tomorrow. And that's why they're giving you that money. They have the hopes that as part owners, this business will make enough profits that they'll benefit from. And this is where we have the stock market. So you can see I'm breaking this thing down to the business. There's something about the stock market that mystifies people. Like they hear things like algorithm, robo trading, maths, formula, and so on and so forth. It's basically a business. It's simple. When Apple went public, they took money. People bought those shares from Apple. Apple said, oh, this is our business in 100 pieces. This is the value of each. And people bought it. And Apple took that money and spent it on whatever they wanted. And now they've taken the people's money, those people that owns part of that business. Now let's ease into how the price of shares are determined. Who decides if the share is 10 naira, $10, 100 naira? Who decides that price? Is it the government? Is it the security exchange? Who determines the price of the company? Is it Apple? Is it the company itself that decides the price of that stock? We have investment bankers, we have professionals that will carry those shares and they will offer it to other institutions. They offer it to banks saying that, okay, Apple is going public, they're selling their shares for $100 each. Are you interested? Now look, if you invest in Apple, you become part owner. And Apple right now are making iPhones, which everyone is using. We just found out that they're coming up with a technology where the phone in the next 5 years, it will just be a ring that you put on your finger. That will be the new iPhone. Samsung does not know about this technology. No one else knows about this technology. And you know Apple, most times they deliver. So they go out and market these shares like that and offer it to people. Now, people out there, these institutions, these initial investors, might look at it and be like, okay, you know what? I believe in you. Take the $100. That is literally the only time that a company can decide the price. After then, virtually no one decides the price of a stock. The price of a stock is decided by the market. Don't worry, I'm not going to confuse you. Let me make that simple. You have this shirt that belongs to you. You're part of a shirt and you're walking around, and someone walks up to you and say, hey, I love this shirt. This shirt is perfect. Can I get it? And you may be like, oh yes, I got it from Pep. I got it from ShopRite. And you'll be like, stop. No, I want this shirt off your back right now. I want to buy this shirt off your body right now. How much are you going to sell it to me? Now, they are offering to buy your shirt. So now the choice is yours to either sell that shirt or to turn down the offer. But you know they're just saying that there's always a price for everything. So you might be like, hold on, I don't mind selling this shirt to this guy and going back home to get another shirt. I bought this shirt for 1,000 naira. I could sell it for 5,000 naira, take that money, go back to the market and buy 5 more shirts. So I could turn this 1 shirt to 5 shirts. If I sell this to this guy for 5,000 naira. So you tell them, I'm sorry, I don't feel like selling it, but if I'm going to sell it, I'm going to sell it for 5,000. Now, it can decide to give you 5,000 right there and then take the shirt. That is on the offer. You've given them a price, they can close the deal, pay for the shirt, and walk off. That is a concluded deal. They have that option, or they might say, you know what, I don't think this shirt is valued at 5,000. I think you are taking a piss. So here's it. We're going to give you 3,000 for the shirt. We feel 3,000 is even generous. Now you have two options. You can still say, no, I'm not selling a shirt, or you can take the offer. The moment you accept the offer and give them that shirt, you sell that shirt to them, the price of that shirt is now 3,000 naira. Anywhere in the world, nobody can dispute that fact. Once you agree, they give you their money, you give them the shirt, the transaction is concluded, it is recorded anywhere in this world that shirt, even though you bought it for 1,000, even though you've used it for some days or a few years, that shirt's value, that shirt among every other of its counterparts, that particular shirt, it's valued at 3,000. Nobody can dispute that fact. That is how the stock market works. That is how price in the stock market is determined. So let's go back to our example. Let's say you have Apple shares. You bought the Apple shares for $100 and you're holding on to that share and say, I'm not going to sell this shares no matter what. But you know what? If somebody is willing to pay me $300 or 300 naira for this share I bought $100 or 100 naira, if somebody is willing to pay me 3 times the value, I'll sell it right away. So in the stock market, the price of share, the price of stock changes when people close deals on the stock market. So that share, that stock you bought from Apple for a price of $100, if you sell it for $110, all over the stock market, it will be recorded that somebody just sold this share for $110. So now going forward, the price of this share in the market is $110. It's going to be registered there. Now remember, we have so many of these shares scattered around the world. Somebody somewhere will be like, oh, I bought this thing too for 100 though. And somebody somewhere just sold it for 110. I'm ready to sell for 110, so they sell his own. So that's another person selling for 110. The price is not changing, it's moving flat. Somebody somewhere might look at it and be like, ridiculous. I know I bought it for 100, but for an extra 10, I would not even sell it for an extra 10. I won't sell it for an extra 20. Probably I will sell it if it's 150. I want to make 50% of the value I bought it at if I was to sell it today. If somebody in the market that is interested in buying that share, if the person is willing to pay 150 for that share, the price automatically changes everywhere in the market to 150. That is how the price is determined. That is how the price rise in the stock market. People offering more than the last market value to acquire the share, to acquire the stock. Straightforward and simple. Now, the opposite thing happens when the price goes down. It means that, yes, I bought it for 100, and other people in the market are looking at it like, you know what? We that don't have it, we know you guys paid 100 for it, but we feel it's too pricey, so we are willing to take it for 90. Now, if nobody accepts those offers, if everybody that owns the share say, I'm not going to sell it for 90, that's ridiculous. It's valued at 100. Nothing happens. Nobody accepts it. But if someone accepts it and be like, you know what? I know I bought it for 100, but give me 90. I'll take 90 for it. And automatically, the price of that share drops. The price everywhere in the world will now move from 100 to 90. Because somebody just executed a transaction. Somebody just concluded a deal for it at 90, even though it was previously worth 100. That is how the price goes down. Now, your next question should definitely be, why would anyone in their right mind who bought this for 100 now sell it for 90? That's making a loss. Who will throw away money? There are many reasons to change your mind in the stock market. Maybe there's an emergency, the person needs money and he doesn't have cash on hand, and all he has to his name is that share, and he's looking to sell it ASAP. He needs cash right now to sort out his emergency. He goes to the stock market. I already have this thing for 100. I just bought it for 100. I need cash right now. He looks at what is on offer. Nobody's offering 100. Nobody's offering above 100. The next offer there is 90. Yes, he bought it at 100, but the offer on ground is 90. He needs cash right away. The emergency cannot wait. That's a reason for selling a share or lower than what he bought it. But that is just one reason. Somebody could have bought that share, that Apple share, for 100, believing that it's going to go to 200 in a few days or in a few months' time. The information he had about Apple was fantastic. These guys are the ones making iPhone every year. They make MacBook. They have Apple TV. So everything looks promising. You are so sure that the value of that business will continue growing. Hence why you paid $100 for it. So why would you sell it for less? Why would you change your mind? A scenario is if you discover, so after buying it for a nice price, you now discover you heard some news somewhere, insider information that, oh, hold on, I'm hearing rumor from Apple that they would not make iPhone next year. For some funny reason, they will stop the production of iPhone. You can immediately change your mind like, whoa, I bought into this because of the iPhone brand, because they sell iPhones and I feel that people keep buying iPhones, hence why they'll make money are able to get profit from that. But now there's new information that they'll stop producing the iPhone. So I think this business will crash. I don't think they'll make enough profit next year. I think that when more people hear that they're not making an iPhone, they'll come and take their money out of this business. So because of this new information, I'm leaving this business early. So I'm going to sell it at 90. I feel that some people won't sell it for 50 if they hear. So let me quickly sell it for 90 now, cut my losses and leave. That's another reason. There are several reasons why people would be willing to take losses on something they were so sure would grow. So now you should be thinking, whoa. This is not as simple as it sounds. You're not saying that what if somebody finds out this information or that information? What's going on here? So how do I find out most of this information? How do I know things about this business? So part of the reason why they call the businesses public, they say, oh, it's a public company, is that because it's a public company, public companies are meant to display all the information to the public. So for example, a company that's not a public company does not have to share information with anybody. Really share it to the people concerned. Or a public company, because anyone can buy into it. And some people, before they buy into it, they want some information. They want to know what was last year's revenue. Revenue is the sales they make, what they sell. They want to know what expense was. They want to know what profit was. So to make that decision easy for people, public company put all their numbers, all the information online. So now there's one called an income statement. Don't worry, that's just big grammar. Income statement is a big grammar. That word is so unnecessary. Income statement. Even hearing that statement is giving me a headache. It's just simple math. Everybody has an income statement. Like you in your life now, you have an income statement. There's no human being, there's no organization that does not have an income statement. So let's make the income statement very simple. You right now, your salary is 100,000. So that's your income statement. 100,000 is your revenue because that's your income. That's your salary. The money that you get every month. After working, you get that money. That is your revenue on your income statement. So what else is on the income statement? We have expense. So now, after that salary they gave you, you pay rent, you pay transportation, you pay for internet, you buy food. Those are your expenses. See, income statement. That word income statement is so unnecessary and so bogus. Just don't worry about it. It just shows how you get money, how much you got, and how you spend that. You pay tax now. Don't you pay tax? You pay tax, you pay pension. It's part of the income statement. So let's go back to public companies. A company like Apple will release its income statement. You see how much they made in total for that period. So, okay, we made $1 trillion. That's the money that they made, income. So after that income, we'll now start seeing expense. We'll see cost of goods. Cost of goods is very straightforward. Maybe Apple made all these phones, all their gadgets. Remember, to make the phone, they need to go and buy aluminium. They need to go and buy titanium. They need to buy glass. They need to buy chips. They need to get the software person to put it all together. The hardware person, the engineer to design it, make sure it's functioning, make sure it does not overheat, make sure you cannot just bend it and to break. All those people would have worked on that phone before Apple now carries the finished product. They put it in a box, a package, and they say, okay, the price is $1,000. And businesses will now buy those phones from Apple and now go and resell it again for their own profit. So Apple needs to pay expense. That's the cost of goods is everything Apple spends money on to produce the phone, to give you the finished product. Then we have things like advertising costs. Our new iPhone is coming. It has this feature, it has this feature. You pay for those adverts. You put it on TV, you put it on the Super Bowl, anywhere you advertise products. It costs something, that's an expense. They'll take it out of the total sales they make. After that, Apple needs to pay tax. They'll remove the money from the income. Now, if after removing all the expenses, you remember I said Apple made $1 trillion. Let's say all the expense now turns out to be $1,100 billion. $1,100 billion. It means that we'll minus the $1 trillion from the expense from the income, right? But there's still $100 billion that is the expense that Apple needs to pay for. That means Apple is making a loss. They've lost money because they're overspending more than they sold. Some of you are like that. Some of you are making losses every month. When your salary comes, transportation will take like 30%, shelter will take another 30%, feeding will take 20%, the money you send around to people will take another 30%. You're already making a loss. So just like we can make losses from our personal expenses, income and expenses, businesses also can do that. It's not a taboo. It happens. In 2020, during the pandemic year, a lot of businesses made losses. That is because no one anticipated the pandemic, the lockdown, and all that. So a lot of business made losses. So it happens. It's not always bad businesses that make losses. But we all know that we want to be associated with businesses that make profits, not businesses that make losses. So that's our income statement. Quite straightforward. It just records, it displays the money that comes in and how we spend it. And if at the end we have profit left. There's another report that people use big name for. They call it balance sheet. Balance sheet sounds like this aggressive word, balance sheet. But balance sheet is also very straightforward. It's something that is our day-to-day life. This report shows your assets and your liabilities. Now, if you own a house, that is an asset because it's your property. It's something that has value that you have. That house could be worth 100 billion. So you have an asset of 100 billion. Liability is An expense, something you owe someone is an expense. It's something you owe someone. So if you have a loan with someone, that will be recorded as a liability. So remember, you have this asset of 100 million, the house worth 100 million. Well, if you have a loan of 50 million, then that 50 million would be your liabilities report, while the asset, 100 million assets, will be in your asset report. Now, why is this useful? There's something at the end called equity. Another big word. It's not necessary. So now you own a house worth 100 million, right? So if they ask you, how much is your worth? How much are you valued? Like you, Mr. Man, since you own a house of 100 million, what's your value? If you tell you now, how much will you get? Like, what is your value? You will say 100 million because you own the house that is worth 100 million. So if you need cash right now, you can quickly sell the house for 100 million. But that is not your worth. That is not your equity. Your worth is everything you own minus everything you owe. If you're owing zero, then your worth is 100 million. But in this case, remember we say you have this loan of 50 million. So we say, what is your worth? Your worth is not 100 million. Your worth is your 100 million, your assets, minus a liability, which is 50. So you are worth 50 million. Get that? So that's what the balance sheet is just showing. It's showing that, oh, as a business, we have all these assets. We have offices, we have equipment, we have products that we've sold, but they've not paid us money. So those people are still owing us money. It's going to come. It's not in our bank yet. It's coming. It's called receivables. We have it out there. Now, all the businesses also have the liability part. This is where you see that loan. If they have loan, it will be in this part. If they're owing money, it will be in this part. So businesses work on credit. A business can be running generators, backup power, and the diesel supplier would come and supply the diesel every 30 days. You could tell the diesel man that, don't worry, I'll be paying you every 30 days. After you deliver your diesel, I'll pay you within the next 30 days. If by the time of this report, that 30 days is not up, I've not paid him, it will be in this liability part. It's called accounts payable. People that have offered me service that I am to pay. And there are other lines in this section, there are other liabilities that fall under this report. Now you might see something like current liabilities or current assets. Current liabilities or current assets is the same thing as normal assets and normal liabilities. The difference is that when they put current in the name, it means that if it's an asset, it means that you're expecting that asset. You're expecting that money in the next 12 months. Within the next 12 calendar months, this money will have entered. If it's liability, if you're owing it, within the next 12 calendar months, you should pay that liability. Whether you own it or you're owing it, it means that in 12 months, the one you own to come to you, the one you owe, you have to settle it. That's what that means. So I hope that's not confusing. So anytime you hear financials, income statement, balance sheet, I don't want you to start freaking out. It's something that is in our daily life that all these finance people are putting big grammar to it to scare us. Now we're moving on to the profit. You see, the goal of every business is to make a profit. Why would you invest in a business that will not make profit? All of us, when you are looking at a business you want to invest in, stock you want to invest in, it's because of the profit. There's nothing you tell them. The goal is for that business to make a profit. Every business wants to make a profit, right? So why is the profit important? As a shareholder, you're a part owner of that business. So when the business makes profit, you own part of that profit. It's your entitlement. And you should be like, wait, bros. Are you saying that when I look at Apple's income statement and I see a profit of 100 billion, am I entitled to that? As a shareholder, yes, you are. You are. That is part of your money. That is the reason why you're a shareholder. You've bought into that business. You've said that I'm buying into this business. I'm a part owner. So every profit they make is your entitlement. And those of you that own stocks will be like, bros, calm down. Nobody has given me profits. Nobody's even telling me about this profits. There's something called a dividend. A dividend is profit. Did you get that? Let's say I invested in Apple. Apple now made a profit of 100 billion. Apple can decide to say, okay, from this profit you made, 80% of the 100 billion, that's 30 billion. The owners, it belongs to the owners of the business. We have to share it among the owners. The owners should share this profit. You are part of the owner. And that profit would now be distributed among everybody that owns the share. That is where you start hearing people saying that, oh, I only buy shares that pay dividend. Dividend share. That's the only thing I want. I want to be making profit from the shares I own. I want it right away. But if you're looking at the stock strictly from the eye of, oh, I'm buying this stock because of dividend, that can be short-sighted. It's not the end all be all. For example, you could own an Apple stock. The dividend there can be $9. So if you own one stock for the whole year, 12 months, the profit, your own share of that profit is only $9. And you should be like, that is too small. Why would they just give me $9 out of 30 billion? Okay, that 30 billion is going to be shared among all shareholders. Now, Apple has millions of shareholders. So when we divide that 30 billion by the millions of shareholders they have, it might end up to be just $9 per person. You get it? That is where we now get dividends. Dividends is the part of the profit that is being shared with the shareholder. Warren Buffett gets dividends from Coca-Cola. So Coca-Cola every year, after selling their super serum, and people are drinking sugar, aspartame, and so on and so forth, they make their income, they pay their expense, profit is left. a part of that profit is now going to be distributed, shared among all the shareholders. Now, Warren Buffett gets as high as $600 million per year just from Coca-Cola, paying part of that profit. And you'll be like, whoa. This is not fair. Why is this old man getting more than all of us? This profit is shared per one share. So they're sharing the profit $9 per share. If you have 20 shares, that means you will get $180. So you are getting $180. Somebody that has one share would only get $9. You understand? So Warren Buffett could have 80 million shares. He has 80 million shares and they're giving $9 for each share. So we just do 80 million times 9. And that is where we're getting 700 million from. So it's not cheating. He has acquired over 80 million shares. So you too, if you acquire 1,000 shares, when it's time for them to pay dividend, they won't just pay you $9 for the 1,000 shares. No, they'll pay you $9 per share. And for your 1,000 shares, you would get $9,000. I believe that's straightforward. You understand that? So now we'll move to growth stocks. So stocks and shares that pay dividends are referred to as dividend stocks. Dividend stocks. It means that they use a part of the profit. They distribute it back to shareholders. Now you might ask, why are they not sharing the whole thing, the 100%? Are you a thief? Why should they share the entire profits and eat it? Apple might need other things. They might need to build new offices in Gombe State, in Bauchi. Why should they spend all the profits just to give you back? They can use part of that profit to develop the business, to put the business in a position where in the coming years, they will make larger profits. So when the business you're invested in is saying that, okay, out of our profit, we're sharing this part of it, don't start crying that they should share the whole thing. Come on now, who eats all that profit? So now we're moving to growth stocks. Growth stocks are the same with dividend stocks. Let me explain. Dividend stock and a growth stock, they are the same thing. They are both normal stocks. The difference is that growth stock, at the end of the year, they're not paying you dividend. Example, if you own Google stock, Google to do your search, Google YouTube, Google Gmail, if you own that stock, at the end of the year, they don't pay you any dividend. They don't. Another example is Disney. You know Disney, Mickey Mouse, Disney Marvel, Disney Fox, Disney Star Wars, and so on and so forth. Yeah, Disney. They don't pay dividends. Now, I purposely use these two examples. Google are not paying dividends because at the end of the year, after making a profit, they take that profit and put it back into the business. They get better technology, use the extra profit in hiring more intelligent people, use the money to carry out better research, and so on and so forth. There's this understanding between Apple and investors in Apple that, hold on, don't come and be waiting every year for profit. We're using the profit to grow this business. So that is an example. You might not be like, wait. So why am I in this business? If they don't pay me a dividend, why am I investing in them? In the stock market, you don't just make your money from a dividend or dividends. That's not the real source of making money. Remember earlier we mentioned when you buy a stock at this price and somebody wants to buy it off you now. And you'll be like, okay, I can sell it, but I will sell it for a price higher than how much I bought it. That is making money in stocks or in shares through capital appreciation. It simply means that you are making your money by selling it at a higher price than you bought it yesterday. All those stocks are reviewed. I'm showing you the percentages they go by at the start. All the stocks I showed you at the start that I reviewed, and I showed you this percentage, they are all capital appreciation. It means that when I reviewed those stocks, the price was 1 and now price is now 10. That is what capital appreciation means. You are making money by the value of the business, of the share, changing upwards. The second way is through a dividend, through dividends. So back to growth stock. I've explained the example of Google. What about Disney? Why is Disney not paying a dividend? The reason is different from that of Google. Disney used to pay a dividend. They were paying a dividend yearly previously, but that changed when they started making losses. So that year we all went to the cinema and watched Avengers Infinity War and Avengers Endgame. All that time, all the profit they made then, they were paying their shareholders a dividend. But after Avengers Endgame, COVID happened, there was a pandemic, there was a lockdown. People were no longer going to the cinemas and they were making money from people going to go and watch movies at the cinema. So most of those movies they produced was postponed. So movies that should have aired in 2021 and 2022 were extended, were moved to 2023 and 2024. That's just one part of it. They also make money through that theme park. So Disney World, Disney Park, but because of the lockdown, they could not make money in 2020 for that. These were the core of the revenue they had. So when their revenue core was affected, they could not afford to pay a dividend. Hence why they stopped paying dividend. And since then, they are yet to continue. But there's hope that now things are getting better, they would continue paying dividend, resume to paying a dividend. And you notice since COVID, the Disney stock price has been affected. It has crashed. It has gone down. It's not magic. It's not any algorithm. It's not any math. It's simply that people noticed that they were making less money because patronage of theme parks of Disney World were being affected. So people were saying, you know what? I was willing to sell this stock for $100 before, but I don't know where things are going to stabilize. I don't know when Disney will continue making the kind of money they were making in Avengers Endgame. I don't know when they will go back to making that sort of money. So let me sell that share now and go and invest it in something else like Tesla or Netflix or Microsoft. Let me go and put that money somewhere else. And when I believe Disney is beginning to pick up, I'll come back to it. Most investors did that. Now you might be like, oh, were they selling at a loss? Not everyone was selling at a loss. You could sell at a price lower than the market price, but not be at a loss. So those people that bought Disney when it was $90. Now, when we had Avengers Endgame, Disney stock was, in this example, $200, right? Fantastic. They bought at $90. Now it's $200. They're still holding it. They're not selling it yet. Now, COVID now happened. Well, they bought it at $90. COVID happened. People started selling it off. So it was $200. Somebody was like, you know what? I can take it for $190. Somebody was like, oh, somebody just sold it for $190. People willing to buy it that say are pricing it for $180. You know what? I'll take that. Remember, I bought it at $90, so I'm making a profit. And a lot of people selling, they are not making losses. They are just selling it lower than the current market value. They only start making a loss, start losing money when they sell it below the amount they bought it. But they can decide to sell it for a lower amount if that lower amount is still higher than the amount they bought it. That's still a profit. I hope I'm not confusing. So that's the explanation for growth stocks. Now, people look at stocks in different ways. You might be like, oh, I'm investing in growth stocks because growth stock grow faster. I'm investing in dividend stock because dividend stocks are matured businesses, are businesses that are steady and all that. So no, the market is much more dynamic than that. There are dividend stocks that make fantastic beta appreciation, and there are growth stocks that are growing at a very slow pace. So because it's a growth stock and they don't pay dividend doesn't mean that the price will skyrocket. And because it is a dividend stock and they pay dividend doesn't mean that the price will go slowly because they're paying dividends. No, it doesn't really work like that. But people tend to generalize it and say, oh, growth stock grow faster. The prices go higher faster, and dividend stock is this and that. No, it's never black and white. There are gray areas here. But if you're taking shares and stock, if you're taking it as what they actually are, which is taking them as businesses being managed by human beings, you would make better decisions. You would understand this in better and make better decisions. Remember that example we used earlier, the example of Warren Buffett receiving over $600 million every year from Coca-Cola as dividend. Okay. Coca-Cola share price has been over $60 for a while now. At the start of 2024, it has been hitting $60 for a few months now. Warren Buffett bought his Coca-Cola stocks in 1989 and is still holding them over 35 years later. That is long-term investing. Now, I understand if you cannot see beyond your nose. I understand that it's totally natural. You're not a weirdo. Let's say Warren Buffett owns 80 million Coca-Cola stock. If you want to own that same amount of stock to be enjoying over $600 million every year, you would need to pay $4.8 billion to afford that number of Coca-Cola stock. Meanwhile, when Warren Buffett bought this stock in 1989, it was only valued around $150 million to $170 million. So you see the difference here. If you have to do it now, you see you're spending how many billion to be getting $600 million every year. But because of his long-term investment strategy, he paid under $200 million for these Coca-Cola stocks. And now Coca-Cola is giving you over $600 million yearly. That is only possible when you practice long-term investing. I bought 5,000 of these bank shares in 2019. Each one was worth 68 kobo back then in 2019. Right now, that same share, each one is worth 8 naira. In 4 years, my shares has grown over 1,000%. This is a share, not cryptocurrency. Now, I could have sold when my profit was 50%. I could have sold when my profit was 100%. I could have sold when it was 200%, 300%, 600%, 900%. But staying in it, holding it for the long run, having a long-term plan, made me hold on to this stock till now that my capital appreciation is over 1,000%. So what's the goal here? The goal is to make this a retirement plan, to accumulate so much of this share that after some years, the dividends they pay me will be similar to that Coca-Cola is paying Warren Buffett. That's long-term thinking. I'm not saying this particular stock will do that. I'm just giving an example of the advantages of investing long-term, not just investing to make 50% and going out. So when you leave the market after 50% profit, what else? What happens? Now I'm just asking, if you make 100% profit now from a share you invested, so you now have 100%, would that 100% in profit change your life? Would that 100% in profit buy you a house? Would that 100% in profit feed you till you're 100 years old? So you have to start strategizing, have to start thinking ahead with these investments. Now, with everything I just told you now, there's something called risk when it comes to the stock market. The stock market is different from the bond market. The bond market is when you borrow your money to someone. You borrow them the money, So they have to pay you back the money. The stock market is different. The stock market, you are buying into that business. You are taking the responsibility to say that, take my money, do whatever you want with my money. I want to own this business. It means that if the business crashes tomorrow and they say they cannot pay you back the amount you put into the business, you cannot do anything about it. You cannot sue anyone because you took the responsibility of giving your money, buying that. You're buying, you're not loaning, you're buying into the business. You're not loaning the business money. So there's risk there. The risk there is that your money can lose value. Those people investing in Disney were doing fantastically well till COVID happened, and no one was expecting COVID. No one was expecting the shutdown. And it happened. And the number of people who were buying when it was very high. When Avengers Endgame was airing, lost money because it was shortly after then the crash started, and a lot of them that bought it at the peak had to quickly sell at a loss. Disney is not far from going back to where it was. They just need to drop 2 to 3 fantastic movies at the level of Avengers Infinity War and Avengers Endgame. If they can do 2 to 3 of those movies, the Disney stock may skyrocket again. So just be aware of the risk. And at this stage, I would warn you of the mistakes people make when they are entering the stock market. The 2 major mistakes I'll tell you about: emotions and not having a mind of your own. When it comes to stock, no matter what, even someone that reviews stock, let's say the person is reviewing stock at 100%, all the stock you have reviewed are making 100% profit, 1,000% profit. Even at that, don't be a sheep. When someone says, oh, this is what I'm invested in, I've reviewed the stock for you, I've reviewed this, a fantastic business, I'm going to invest in it. The ball is still in your court to decide to take your money and buy into that stock, into that share. It is your decision, no one else's. So if you see people investing in Disney, oh, Disney is cheap, then I'm gonna buy it now. Or let me buy Microsoft or Apple. Okay, no, I watch a stock review of Lockheed Martin. I watch a stock review of Zimmer Biomet. I just get into it because somebody reviewed it, because somebody said his cousins, friends, wives, uncles, auntie knows somebody that works in those companies and they're about to make an important announcement. So that is leading you to make a choice. It is your responsibility. A mistake I see most people make is that they just go to Twitter, they go to YouTube, they watch videos about stock, they quickly write the name of the stock, they go and buy it because somebody just told them that, found out that the stock is going to blow up in the next 2 days. Here's an example. After watching this video, search on YouTube market collapse. You will see millions of videos about market collapse. Oh, the market is crashing. The government have destroyed the market. The market is coming to an end. The stock market is all red. Look at how many videos people keep releasing on them. 2 different periods. There were a lot of those videos last year. There are those videos already showing in 2024, this year so far. Those videos were in 2022. And if you're just listening and just selling and selling and selling, you know how many mistakes you have made. And it's also the same thing the other way around. Instead of searching for red market crashes, also search for stocks to buy now. You see a lot of emotional videos, messages saying that, oh, this stock is going to blow up, buy now, buy now. And look at the hundreds of stock that they're asking people to buy now. Now look at the performance of those stocks from the time they published those videos till now. Are the performances matching the promises in those videos? You can check that later. And remember, I mentioned emotions earlier. Understand, if you're still new to the stock market, when you buy a share, you would be watching its performance closely. Every 5 minutes, you'll be looking at a chart. Oh, is it going down? Maybe I should sell. Or maybe I bought at the wrong time. Maybe I should sell. You are being emotional with your money. Look, it's never pays anyone to be emotional with money. You have to be logical with money. Trust me, you always have to be logical. And if you listen to everything I said in this video and understand these businesses the way I explained it, you will not need to be emotional. You would know why a business is making money. You would know why the numbers are performing, and you buy it knowing that you're holding it for the next 5, 10, 15 years. So your next question at this point should be how to buy shares, how to buy stocks. This is the simplest question. You just simply have to find a stockbroker. And don't worry. I'm not asking you to go around your city looking for stockbrokers. You can actually find stockbrokers right there where you're sitting right now. After this video, just go to your app store, go to Google Play Store and search for stockbroker. You see options. Here in Nigeria, we have Shaka, we have Trove, we have Bamboo. These 3 are the popular ones that allow you to invest in Nigerian stocks and also invest in international stocks. We also have stocks that allow you to invest in Nigerian stocks. And these apps are very easy to use. It's just like a banking app. We have Afi Invest. They have a website. You could use the website or you could get the app. The app is called Afi Investor 2.0. We have ARM Stock Trade. We have Meritrade. We have Stanbic Stockbrokers, and so on and so forth. So get these apps, go to their website, register, do your KYC. They ask you similar questions to that of a banking app. And once they verified you, you're ready to start buying stocks. You're ready to start buying shares. It's as simple as that. You just come back, watch this video again, follow the principles, and it will guide you in selecting stocks. If you have any questions, let me know in the comment section below. Anything you feel like asking, I am going to be there to assist. You think you've learned everything about your money in this video? Why not watch this next video? You'll be surprised what you don't know. If you like, smash the like button. Just remember to subscribe.